Hi everyone, welcome back to the channel. Today I'll go back to the old days when I was teaching at university. We're talking about one of the most important ideas in investing, something that shapes almost every financial plan, every portfolio, and even the way your RRSPs, TFSA, and pension plans are designed. It's called Markowitz investment theory, also known as the modern portfolio theory. And don't worry, it sounds complicated, but I'm going to make it incredibly simple. Markowitz basically discovered something that changed investing forever. The goal isn't to find the perfect single investment. The goal is to build the perfect combination of investments. And this combination, your asset mix, is what actually determine your long-term success. Every investment has two things: a potential return and a level of risk. What Markowitz proved that instead of chasing the highest return investment, you should aim for the best return for the level of risk you're comfortable with. That's what we do when we build diversified portfolios. Here's the magic of the theory. Investments don't all move the same. When stocks goes down, bonds might go up. When the Canadian market is flat, global market may rise. When inflation goes up, real assets or gold may stay stable. And when you combine these different behaviors, your overall portfolio becomes smoother and less stressful. Markowitz also created something called the efficient frontier. You don't need to memorize this, just understand the idea. Imagine a curve that shows the best possible portfolios, the ones that give you the highest return with the lowest risk. Anything below that curve, it's simply not efficient. You're taking more risk than necessary. As a financial planner, I am applying this theory to make sure your portfolio is properly diversified, you're getting the growth you need, and your risk is aligned with your goals and lifestyle. This is why asset mix is more important than stock picking. Let's say you put everything into one investment, 100% stocks. Yes, long-term growth may be high, but so is the stress. But if, for example, you combine 60% stocks, 30% bonds, and 10% alternative or real assets, you might get almost the same return, but with much lower volatility. That's the power of smart diversification. So here's the simple takeaway. Don't put all your eggs in one basket, but put your baskets in different markets. This reduces risk, increases stability, and helps you stay invested longer. If you want to know what an efficient portfolio for you, a diversified one, looked like, your age, your goal, your risk level, feel free to reach out. And don't forget to like, subscribe, and leave a comment if you want me to cover more financial topics. And remember, smart investing is not about timing the market, it's about designing the right mix, and that's exactly what Markowitz taught us.